name is Dr. Lawrence Souza. I'm a professor of finance here at St. Mary's College in Moraga. I'm also the chief economist for a company called capitalbrain.co. It's my technology company. And I'm also the vice president of research and analytics for a infrastructure energy company called GreenSpark. So let's put the economy and the real estate cycle in perspective. We're in one of the longest expansionary periods post World War II. We're about 2 years beyond the average recovery period and growth period. They usually last around 7 years. We're into the 10th year right now, so we're a little bit late in the game. I think we're in probably the 9th or the 10th inning of this expansion. We have to put it in perspective too. We went through the worst financial crisis and recession post World War II. The last recession in 2008, 9, 10 was twice as deep and twice as long as any other recession, and the damage from that last recession is still being felt, particularly in the heartland and in other industrialized communities across the United States. Here in the Bay Area, we kind of live in a bubble. Unemployment rate is extremely low. Job growth is still very high. The tech sector is the dominant sector, particularly in downtown San Jose and along the San Mateo County Peninsula, and definitely in downtown San Francisco has become the dominant industry that's been generating the majority of the jobs and actually the real estate activity. There's been a lot of news lately. I think the trade war is definitely a macro factor that needs to be discussed. Because of the trade war, exports and imports coming in and out of the United States and actually even China has dropped significantly, and the global economy is falling into a recession. If you look around, Germany had 2 quarters of negative GDP. Japan has obviously been moving in and out of recessions over the last 14 years. Argentina is a basket case. Brazil's a basket case. Italy, is in a recession. Greece is in a recession. Spain is actually doing pretty well, but borderline, recession. You have the UK that's going through Brexit, that's actually caused economic activity out of the UK to decelerate rapidly, and actually the pound has devalued and depreciated significantly over the last 2 years since Brexit. So if you look at it on a global basis, the economies are starting to slow significantly. Some are falling into recession, and actually you're starting to see negative interest rates be introduced again in a lot of those countries. And negative interest rate basically points to disinflation or deflation going forward. And I can touch on the impacts of negative interest rate policy in a second. What happened over the last 2 weeks, which is what I've been talking about for the last 5 to 8 years, is an inversion in the yield curve. And that's a very important event. It basically means that interest rates on short-term US Treasury securities are now higher than long-term Treasury securities, long-term interest rates. And short-term rates are right now are yielding around 2%, and the long interest rates like the 10-year, the 20-year, the 30-year is around 1.5. So the yield curve now is around negative 50 basis points. Usually from my research and research that I've studied over the last 5 to 8 years is when the yield curve inverts, the stock market peaks in less than 12 months, and we go into a recession in less than 24 months. So if you kind of just do the math, if the yield curve inverted in August, we're basically could be looking at a recession by August 2021. It seems like the labor markets here in the United States are doing extremely well. I mean, we've averaged about 200,000 jobs a month for the last 2 to 3 years, which is extremely healthy. The unemployment rate is at historical lows of 3.4%. You have one of the issues here is the unemployment rate is not really a great measure of labor markets. I like to look at labor participation rates. That really measures the slack in the labor markets. And I also like to look at underemployment rates. And the underemployment rate is really double the unemployment rate. So the underemployment rate is probably about 8.6. And the labor participation rate right now is around 62, 63%. That's historic lows. So there's a lot of slack in the labor markets. We need to get, teenagers and more minority individuals and older individuals back into the labor force, and that would actually improve gross domestic product or growth in the economy. Let's talk about gross domestic product because that's one of the targets that the Federal Reserve looks at. Just yesterday, the second quarter revision of gross domestic product just came out at 2%. In the first quarter, it was 3%, and that's really where the Fed is targeting. And last year in 2018, the economy was growing at 3%. So that's kind of what they're looking at is 3 to 4%. But if the economy is starting to decelerate and the global economy is starting to move into recessions, the Federal Reserve needs to be a little bit more aggressive, in their accommodative monetary policy and start to print more money to buy short-term bonds, to drive up short-term bond prices and drive interest rates down, and actually try to get that yield curve to become more normal and to become more steeper. And Donald Trump has been really needling Jerome Powell to become a little bit more aggressive to move down short-term interest rates and try to stimulate the economy. And obviously, he wants to do that because we're in an election cycle. And he doesn't want to be going into a presidential election cycle or even congressional election cycle where you have incumbents, particularly Republican incumbents, moving into a recession, which could actually jeopardize their control of the Senate and could jeopardize their control of the presidency. So the political dynamics and the economic dynamics are really being played out right now, which is an extremely fascinating time period to be an economist, and I encourage my students to follow along and try to teach them how important these things are, not only for themselves, but their careers and also my clients too. So let's talk about what the next recession would look like. If my forecasts, along with others' forecasts, and the predicted capability of the yield curve, which is extremely accurate in predicting recessions going back to the 1970s, and you can go past, post World War II, you can even go back 150 years, and the yield curve has been an extremely accurate predictor of recessions. What would the next recession look like? For one, it won't be a banking crisis. The next recession will not be triggered by a banking crisis. The banks have consolidated. They have very good capital reserves. They're healthy right now, even though if we do move into a negative interest rate policy, the bank's earnings would be impacted and they probably would pull back somewhat on their lending. But what would the next recession look like? My feeling is the next recession is going to look like this. As the emerging markets start to fall into recessions, they will start to see their tax revenues start to fall significantly. If the tax revenues start to fall, there could be risk in the payments of the interest rate, the coupon interests, along with the principals on their sovereign bonds. Over the last 10 years in this last recovery, not only was there over-accommodative monetary policy on a global basis through the central banks printed about $35 trillion, but a lot of these countries have actually expanded their fiscal stimulus and have racked up huge amounts of sovereign debt. So if they start to fall into a recession, they're not going to have enough tax revenues to service the debt, and a lot of those emerging market debt will probably be defaulted on. In Europe, a lot of the banks actually hold the EU country sovereign debt on the bank's balance sheets. So as those bonds start to default, the asset side of the balance sheet at the banks will start to come down. The leverage ratios will start to go up. The capital reserves on the bank's liability side of the balance sheet will start to narrow. And the worst case scenario is a lot of these banks will become insolvent, and you'll probably see another run on the banks like we saw in Greece and Italy and Spain after the last financial crisis. Christine Lagrange, who is now going to take over for Draghi in the EU, overseeing the central bank, has also indicated that she would continue a very aggressive over-accommodation policy, driving interest rates negative, printing money, and not only buying sovereign bonds, but also corporate bonds. And they've even talked about buying corporate equities. That verbiage, that kind of discussion has actually occurred here in the United States under Janet Yellen. She actually told the banks to stress test their balance sheets and their income statements under a negative interest rate policy, which scares me. Jerome Powell has talked about zero interest rate policy and potentially a negative interest rate policy, because interest rates are already so low that you would have to drive them negative to actually get some kind of stimulative effect. If you hear what Lawrence Summers has talked about in his critique on negative interest rates, it's basically a monetary policy disaster, in my view, where you'll start to see disintermediation and almost the capitalist system of circular flows of capital through the system start to retrench. And it could actually even exacerbate the long-term structural growth rates of the global economies that are currently in sync through global trade and free capital markets. We could start to see that system start to degrade. And we actually have seen the democratic capitalistic system at an institutional level over the last 10 years start to deteriorate, and you started to see some cracks in the system. So I'm going to stick with my 2021 to 23 recession. I don't think we'll go into it before that because the economy is still healthy. And usually you don't fall into a recession during an election year, particularly a presidential election year, because the incumbents, both in the legislature and the incumbents of the executive branch, usually push through accommodative fiscal policies to basically buy votes to get themselves reelected. And then usually the Federal Reserve will step in a year or two after the election cycle to raise interest rates to squeeze out inflation that was caused by this over accommodation and fiscal policy by incumbents during the election cycle. I'm hoping that the next recession will be shallow and short, like most recessions. They usually only last 2 years, and then we go into a 7-year recovery. If the sovereign bond crisis really takes hold and pulls the global economy down without really any bullets left in the guns of monetary policy or fiscal policy to stimulate the globe, we could be looking at a protracted recession that could last, again, on average, 4 years, which was the last one. And hopefully it won't be, as deep or as long as the last one. Hopefully it will be shallower, because the permanent damage that has been done to certain sectors of the economy and certain demographics of the globe and the economy has been permanent. And I'd hate to see it happen again, because it was very, very destructive.